All right, here we go. I want to thank you for joining our webinar today on multifamily investments with self-directed IRAs. We have with us as a guest speaker Neil Baba, who's with ARC Funding, who is an investor in multifamily and has some projects going, and he's offered to give us some background about investing in multifamily projects. So, Neil, why don't I transfer control over to you, and you should have it now, and tell us a little bit about multifamily investments, and then I'll come back and talk a little bit about self-directed IRAs.
Perfect. Thank you for inviting me, Neil. I'm sorry, Bill. My name's Neil Bawa, once again, and I've been doing multifamily education for a while, and so it's a bit of a passion of mine. So it's always fun to be invited to an event such as this and be able to share what we've learned. Bill, can you guys see my screen?
Yes, we can.
Okay, perfect. So let's see, let's get started. Let me start off by telling you just a little bit about myself and my company. Me and my partner John Mark Landau, those are our pictures up there. We buy and manage large multifamily complexes worldwide, nationwide, typically 150 units and above, the average being slightly over 200 units per complex. Currently, we've got properties in Dallas, actually multiple locations in Dallas, Houston, Oklahoma City as well. Our latest project is actually in South Shore, Chicago, very close to where the Obama Presidential Library is, very close to the University of Chicago. So that's the project that we are working on right now. We've got deep competency in asset selection and management in multifamily. That matters a great deal. You've got to not only select the right asset, you've got to select the right area, and then you've got to manage it very carefully for maximum cash flow and operating income gain. We've got a lot of real estate experience. My partner started in real estate in 1983, so it's going on 32 years. I have less experience. I started in 2009, but since that time I've purchased and sold single families, duplexes, triplexes, quadplexes, sevenplexes, and I've invested in multifamily in multiple projects in 3 different states, Texas, South Carolina, and Kansas. So lots of experience there. We've done lots of different things, and we bring that ensemble experience to multifamily syndication, and one of the terms that you're going to learn today is syndication. So let's get started. My goal for today, I want to introduce you to the $2+ trillion, that's $2,000 billion US multifamily market. Yes, this is an enormous market, one of the largest industries in the US. I'm going to talk about the latest market trends. What are the mega trends that are driving multifamily growth right now? And I'm also going to talk about how groups of investors club together and buy multifamily properties together, and why it's so profitable. I'm going to give you the top 6 reasons to invest in multifamily, and that's besides those trends that are up there that we talked about in bullet 2. Let me get a laser pointer here. There you go. And then we're going to go quickly through the life cycle of a multifamily project so you can learn about how it's different, because it is very different from single family investing. And if we have time, we'll go through a quick recap. So let's get started. What does multifamily mean? In the most important nomenclature you need to remember is 5+ units. So technically speaking, even if you have 2 units, it's a multifamily. But lenders don't treat 2, 3, and 4 units the same way as they treat multifamily. So in our lingo, it has to be 5 or more units. Now, when a lot of advanced investors are talking about multifamily, they're actually talking about units over the apartment complexes over 150 units, because that's when it reaches a true economies of scale. That's when it becomes a true business, because it has a lot of full-time staff. So while there's lots of great cash flowing multifamily projects in the 20 apartment to 100 apartment range, most of the larger companies tend to go after complexes that are 150 units or greater, because then it's a true business. So how are they valued? And right here, this is the most important slide in my presentation. They're valued very differently from single family. Single families, when you value them, you primarily value them based on comps or comparables. So if the home next to you is the same size, your home is probably worth as much as that home. Well, not so much for multifamily. You could have two identical multifamilies sitting right next to each other, same amenities, same look, same age. One of them could be worth twice as much as the other because they're based on something called net operating income. And here's an example. In a 200-unit complex, the management successfully raises rents by $25 a unit. That's $25 a month per apartment. The value of that property instantly and always goes up by $750,000. And this is how. So 200 units multiplied by $25, multiplied by 12 months, divided by an 8% cap rate, $750,000 value increase every single time. I've been involved in projects, though this is not typical, where the asset management company bought the place and was able to double the net operating income by reducing delinquency, increasing the occupancy rate, and raising rents. Those are the three big ones. And by doing that, they were able to double NOI in a year, and they exited because they had reached their exit qualifications, and they took a 5-year project and did it in a single year. Not very typical. It's been happening quite a bit in the last 2 or 3 years because the market's been red hot. But the reason why that can be done is because of this magic of value based on net operating income. If you do a better job than the last guy, the apartment complex is immediately worth a lot more. In this aspect, an apartment complex is exactly like any other business in America. Businesses are typically valued based on net operating income, and so are apartment complexes. So who manages a multifamily property? Well, the answer is I don't. I'm an asset manager. I'm working on the acquisition of it. I'm working on the numbers of it, but the property is actually run by professional property managers. And I know that in the single family arena, property managers are often a bad word, and there's a reason for that. Most of the best property managers prefer to run multifamilies because for them, they're much more profitable because they're managing, every time they get a new client, they're adding on 200 units or 300 or 400 units. So the cream of the property management business resides in the multifamily area. And they also have full-time on-site leasing agents, full-time maintenance staff, porters, and such that are involved in every one of these projects. Investors and managers, you and me, are not involved in tenants and toilets. That is something that the property manager does, and there's also an asset manager that's involved in those aspects. So this is very important. Sales, cost, and profit metrics are used to run each property just like any other business. And I'm going to elaborate on this because this is very, very important. So let's talk about loans. Very different. Loans are not based on your income or my income or our credit. They are simply based on the property's operating income and occupancy levels and delinquency levels. Now what's interesting is multifamily loans are scrutinized by lenders at length. It is a very long, very cumbersome process because the lender wants to look at occupancy, and they want to look at occupancy over the last several years. What was the delinquency rate over the last 7 years? How old is the roof? Because if you've got to change a roof out for a 250 apartment complex, that's a very large number. So the lenders actually scrutinize all these numbers, and if they find that the apartment complex has a lot of deferred maintenance, they actually force the buyer to impound a large amount of money to allocate for those. So very, very careful lending standards. And really, why is that important? It protects you if you're looking to invest into a multifamily, because the lenders are really doing their job of making sure that the right property is being selected for acquisition. What's the focus on? Well, the big focus tends to be on cash flow and on value addition, and you really have to strike a balance between these two areas. So if you buy an asset that requires a turnaround or a micro positioning where there's some work that needs to be done, well then what you're focusing on is raising that income, the net operating income, and you do that in multiple ways. You're pushing down the delinquency. you're raising rents, you are raising occupancy. Maybe the occupancy is at 80%. By the time you raise it to 100%, you've raised net operating income very, very significantly. So you're not just sitting on the property. You're not waiting for market appreciation. You're doing what is known as value addition by managing the property better. So this also means that there's a choice of balance between cash flow and market appreciation to achieve your profitability goals. Because if you only go for cash flow, you're probably not going to get a lot of that value addition piece. So because that property, you're already buying a property that's optimized, and it's not going to go up from there much. But if you buy a property that has some room for growth or improvement in net operating income, then you have the ability to really raise the profit there. So, but it also means that you have to put in more work in the first year to do all of those things, to raise the rents, to reduce the delinquency, to increase occupancy. And my company, Financial Attunement, we like those kinds of properties. So we specifically look for properties that are in emerging markets and that have been mismanaged to a certain extent. And we come in and we typically do not keep the property management company. We, in 80 or 90% of the cases, will let them go and bring in a better, higher quality property management company. The units that we've had the most success with were self-managed, where the owners were not using professional property manager, where they were trying to manage it themselves. We see a lot of mismanagement there, and we see a tremendous amount of opportunity there. So let's talk about market cycles, right? So multifamily has very predictable market cycles, and that creates identifiable emerging markets. At any point in the US, there tend to be 20, 30, 40 emerging markets, and what we know, savvy real estate investors know how to read those cycles, and we time our investments accordingly to enter markets and exit markets. Let me give you an example, and here's an example. A buyer's market one is essentially one where prices are still falling. A buyer's market two is where prices have been falling for a while and are now flattening out. A good example of a buyer's market two, or just maybe a little bit above, right here is Chicago. So after that, we hit seller's market one, where some of the sellers are beginning to sell, but it's really not time to sell yet. They're selling too early, and Dallas is somewhere in this area right now. And then we have seller's market two, where the market is at peak or approaching its peak, and right here in my book is the city of San Francisco. So as you can see, real estate markets or cycles are not national in nature. They're not even statewide in nature. For example, San Francisco is up here, Sacramento is down here, which is only 100 miles away. So even within a state, different cities are at different points in the cycle, and that's what creates opportunity for multifamily operators. So how long is an investment for? It's very important to understand this is not a fix and flip business. It's a very hands-off business. 4 to 7 year investment cycles are the most common. Now in the last 3 years, it's been shorter than 4 years. So most complexes have been purchased, have been turned around or managed properly and sold within a 3-year time frame because the returns were so high. I now see the market returning to a more normal cycle. So I would say 4 to 7 year investment cycles are common. This is probably also why self-directed IRAs are a phenomenal investment for multifamily. You make an investment, you work with a professional team, and you wait for the asset to grow in value over a 4 to 7 year time frame. Now, volatility, this is really, really important. I think most savvy real estate investors know that there's a lot of volatility ahead of us. The market's been rising for 5 or 6 years, or I'd say probably 4 years nationally now. It's important to understand multifamily is not as volatile as single family. So values don't decline sharply in a recession. Conversely, they also don't go up as fast on a rebound, because values are really based on income. They're not based on hype in the marketplace. They're not based on Chinese investors flooding in with $30 billion and buying everything in sight. Multifamilies don't have that kind of hype. And what's most important is when a recession does take place, people have choices not to buy single-family homes. They don't want to put more debt on their books. So apartment complexes actually get a little bit of a boost. because people move from single-family homes that they cannot afford into multifamilies, into apartment complexes. And so rents tend to fluctuate less than home prices do for single-family. All right, so you're going to come across this in our conversations if you want to engage with us more. We talk about three classes of building: Class A, Class B, and Class C. As you can imagine, Class A is the best kind of building, right? They're usually in downtown. So think downtown San Francisco or downtown Manhattan. These are high-rise buildings. They've got all the amenities in the world, average and well, above average rents, great finishes. There's never any deferred maintenance because they do it all the time. But there's a downside, and this downside is for you and me, for the investors. Because these properties have no hassle and very high occupancy, they have very low cash flow. Because you are taking no risk at all, there's almost no upside. For those that are familiar with cap rates, typical cap rates are 4 to 5.5%, and most buyers are actually institutional investors, pension funds, real estate investment trusts, and so on. So keep in mind, for Class A, cash flow is highly, highly sensitive to recessions. Now, Class B is somewhere in the middle, where these are buildings competing for a very wide range of users, average rents. They're older than Class A, and finishes are fair, sometimes even good. They have decent amenities, usually a pool, sometimes a tennis court, almost always a gym. They have better cash flow than Class A buildings. So for those, again, who know cap rates, 5.5 to 7.5% cap rates are normal. And there's a mix of institutional buyers and private buyers such as you and I. Class C, typically more than 20 years old. They're typically not in downtown areas, so they're in the suburbs. And the property generally has some deferred maintenance that needs to be done. The building infrastructure needs to often be updated: sewers, collapsed sewers, replacing a roof, and so on and so forth. But that represents the opportunity. The institutional players that have billions and billions of dollars of funds do not play in the Class C market. So they tend to have, the Class C market tends to have a higher level of mismanagement. Many of them are not professionally managed, which represents a higher value-added opportunity for investors. Cap rates of 7% and higher, all the way up to 8s or 9s. There is another class called the D class, which I think stands for do not buy, those are in the ghetto areas. They're in the war zones, and I don't believe that any investor should ever touch them, but some continue to do so and suffer. So from my company's perspective, we tend to buy, whoops, what happened here? I'm going to go back. There we go. We tend to buy in the B and the C area. That's because we see higher cash flow, we see much higher returns than Class A, where the institutional investors are okay with much lower returns. Click. There we go. All right. So now that you know a little bit more about multifamily, let's talk about the main trends, the big mega trends that are really driving multifamily growth in the last 5 years and then for the next 5 years. The big one's right here. A fundamental change is taking place across America. Rent is now the new buy. So the National Association of Realtors, imagine this is the group that benefits the most from single families. They're saying that 5 to 6 million new renter households will be created within the next 10 years. It seems that Americans are no longer in a rush to buy homes. So this is really driving long-term demand for multifamily properties. For example, take a look at this circled area. Only half of all renters that have been surveyed, and this is the Wall Street Journal and Appfolio doing the survey, only half of all of those people said they anticipated becoming homeowners in the next 5 years. That number is bigger than it's ever been in history. So renters are also more committed to staying, to renting. For example, if you look at this area here, 1 in 5 apartment dwellers and 1 in 4 individual property dwellers, these are people renting in single families, they plan to stay where they're living for 5 years or more. In the past, people were thinking about living in an apartment for 2 years, 3 years, but they eventually wanted to move into their own single family home, and those trends are changing. People are not buying homes even if they qualify for averages. Take a look at this number, really shocking to me. Less than 1/3 of renters cited the inability to obtain a mortgage as the reason for not becoming homeowners in the near future. Less than 1/3 cited the mortgage piece. And I know this is counterintuitive, and the next couple of slides will really explain them. The word lifestyle choices is really key. So if you look at that, they like the freedom of the renting lifestyle. They like the lifestyle because why? Because they're able to go to safer neighborhoods. They're able to get better schools. They're able to be closer to retail. So the quality of life, parks, playgrounds, community centers, all of those are really important to them. And because of that, they are fine with the renting lifestyle as opposed to buying single family homes. And now, all of the previous slides were really about all groups of people. This slide is very key in my opinion because it applies to the millennials. So after Gen X, this is the group that's now transitioning in as the main driver of the economy. Look at this graph. Millennials' ownership rate or true ownership rate has dropped and is continuing to drop at an amazing rate. So you notice here in 2005 they were slightly above 17%. By now, this is 2014, and in 15 it's continued to drop and has dropped below 13%. So they don't seem to be as interested in buying homes at the same rate as previous generations. I'm not saying they don't want to buy them. I'm saying that the data suggests that they're not buying them for whatever reason. Maybe they don't want homes, maybe they can't afford homes, maybe they're just afraid because they've seen their parents go through a horrific real estate crash in the last 5 years. So this is extremely relevant because what this means is that these millennials are going to need a very large number of apartments. And then finally, the baby boomers. What's happening is that there's 75 million baby boomers, and a good portion of them are actually looking to downsize. And what they're doing is they're looking for urban apartments. So they've got, easy access to amenities, or maybe they're closer to their kids. It's really hard to tell. But these echo boomers are driving up the demand for multifamily. So multifamily right now is in this magical place where a huge number of mega trends are converging to drive up demand for multifamily for the next 5 or 10 years. So I'm going to skip past this because I'm on a webinar and video doesn't play well in a webinar, but essentially that's what Freddie Mac is saying. So look at all those trends, right? Amazing trends. Some of them you knew about, some of them were counterintuitive but very important. Now let's show you how you can benefit from those trends using your self-directed IRA funds. So let's talk about buying together. How do groups of investors buy multifamily apartment complexes? Well, they do it through something known as syndication. So obviously this is a big purchase. Not a lot of people can put down $5 million, $10 million, $20 million together. So groups of investors get together and they use a mechanism called syndication. This is a term defined by the Securities and Exchange Commission, the SEC, and the SEC also sets rules, very strict rules for syndication for the protection of investors. So how does it work? So an experienced team first finds an asset, they put it under contract, and then they offer the opportunity to their pre-screened investors. Investors get to see video tours of the properties. They get to see a very comprehensive financial document that shows projections by month, by year, all of the assumptions that are being made. They get to see the local area. They get to see all of the projects in that area, the amount of property that's being built in that area. Huge amounts of information is offered to them, to the investors, who then choose to either participate or not participate in that acquisition. And individuals, self-directed retirement plans, or entities, in many cases pension funds and even real estate investment trusts invest, and they all invest different amounts. So an individual might invest $50,000 where a trust or a family trust might invest $500,000 or $1 million, and they all get a proportional equity share. This is fractional earning. So you're a fractional owner of the multifamily. And the syndication team, which I'm a part of, they contract the property, they do all of the due diligence. In the case of my latest property, it's a $12 million project, and after 2 months of due diligence, we negotiated a $650,000 repair credit because all the sewers had collapsed and two of the roofs had to be changed. So our team does that due diligence. We organize the offering, we pool the investor funds, and then we manage the property until sale, which usually tends to be 4 to 7 years later. And we receive a share of the cash flow, a share of the profits, and also a small ongoing management fee. Now that fee does not come out of your self-directed IRA funds. It comes out of the cash flow, because remember, we only touch properties that are already cash flowing. So we assign an asset manager and also a property management company, and they manage the property. You as investors have no involvement in the day-to-day running of a property. On a quarterly basis, you get a check and you get a statement from us that explains how the quarter has gone, and then you get a balance sheet or a financial statement that explains how the property is doing. No tenants, no toilets, ever. So, actually want to point, let me go back and point this out. Investors typically get preferred returns before the management team is paid. So let's say the preferred return on a property is 7% or 8%, and the property, instead of making 8%, is making 7.5%. Well, that amount is paid out to the investors, and the management team doesn't get paid because the preferred return is not being generated as yet. All right, so you saw the mega trends, right? And I believe that information was compelling, but those are today's trends. They could change in 10 years. These trends, these 6 trends, are always going to be there and are always going to be compelling reasons for why multifamily should be part of your portfolio. Let's take a look at these. The first one is simply cash flow, right? Multifamilies almost always cash flow, and you really shouldn't be investing in one that doesn't cash flow, because that's the very core of multifamily investment. So every property should be able to generate enough income to cover cost of ops, utilities, maintenance, capital improvement, financing. The rest really goes into the investor's pocket in every month. So exact returns vary, and if you're interested in this, please come back to me and I'll give you more details, but double-digit annual returns are common. Again, double-digit annual returns are common. They are typical in the multifamily market. Second, and this is the most powerful reason being multifamily, and that is forced appreciation. Please note, single family does not have forced appreciation. Well, multifamily values are based on the net income they produce. If you double the profit, you double the value of the property instantaneously every single time. So if the property that we are buying is mostly stabilized, you still have the ability to get some forced appreciation by optimizing management. Maybe it's already at 94% occupancy. Well, you're not going to be able to push it up much more. Maybe you go up 1 percentage point to 95, but you can push it up more if it's under market rents. Remember that example? If you increase rents per unit by $25, you've raised the value of the property by $750,000. On the other hand, if you're buying a distressed property, a property that's not running well, keep in mind it's still cash flowing, but it's not performing to potential, well, then you're really buying it at a discount. And then in the first year, the management team really has to focus on it. They've got to push the delinquency down, push the occupancy up, push the rents up, and that's when they're getting the forced appreciation. Those are the types of properties that my company specializes in. So number 3, metrics. This is important. I know a lot of you are professionals, so you're used to metrics. Unlike single family, multifamily is all about metrics. There are sales metrics, there are cost metrics, metrics around occupancy, delinquency, cost control. And all of the metrics for a particular area are visible and available to the property managers because they're all subscribing to property management software. That's really maybe 3 or 4 different property management software, so the data is available. So if I'm a property manager and my complex is at 92% occupancy, but all of the like buildings around me are at 96%, I'm very worried for my job. So it's very metrics based, it's very driven by professional management, and that's what differentiates it from single family. Inflation protection, and obviously this works for single family just as well as it does for multifamily. You know, the Fed's printing billions of bucks out of thin air, and I believe owning any kind of real estate, not just multifamily, is a tremendous inflation hedge. It really, really, really needs to be part of your portfolio. Tax benefits. So multifams are able to take advantage of depreciation, just like single family, but also equipment can be depreciated. In single family, there's very little equipment, so you don't get those sorts of depreciation benefits. Essentially, this offsets, and I want to be careful how to word this is, so I'll give you an example of what I see. When for my multifamily investments, if I'm seeing a check for $20,000 a year in cash flow, I usually see on a K1 that's for 5,000 or 6,000. So most of the income that's coming in is deferred to the future through tax benefits. Here's my favorite, economies of scale. You absolutely cannot get this in single family real estate. Number one, vacancy impacts cash flow less. When I have 200 units, if 5 people leave in a single day, that's a 2.5% reduction. When I have a single family rental, I go from 100% occupied to 0% occupied. I go from being, very happy to upside down in a single event. That does not happen for multifamily. Marketing is much more efficient because everybody is being brought into a single location. Logistics are easier because you've got centralized operations. Repair and maintenance is very cost effective. Why? Because I've got full-time maintenance staff. And if they're not fixing something, if the building's running well and there's nothing to fix, guess what we do? Any units that are empty, we start rehabbing them. So we're constantly 365 days a year rehabbing the units and improving the finishes. Maybe it's granite countertops, maybe it's better cabinetry in the kitchen. We're doing it all the time, and we're doing it with staff that doesn't cost us any more money. So upgrades can be carried out with less impact to revenue. If you're in an area that's improving and you have a single family there and you want to upgrade the finishes, guess what? You cannot get rent during that time. If you're going to do granite countertops, your tenant is not going to pay you rent while you're doing it. Not so for multifamily, because for a 200 unit, there's always 5 or 6 units that are empty, so you can always be rehabbing. So those were the top 6 benefits, and I have about 5 minutes. So I'm going to go through, and I apologize for doing this very quickly. I'm going to go through the life cycle of a multifam project, and this one's going to be a little bit rushed. So 4 phases: pre-offer, post-offer, post-purchase, and sale. Pre-offer is a tremendous amount of work. Our team goes in, we research the metro. Where are the jobs? Where's the path of progress? What are the pricing trends? What are the local folks saying? We create our team, realtors, inspectors, property managers, contractors. A tremendous amount of work, a tremendous amount of time. And then we start our opportunity search. Once we know what our target areas are, we start doing opportunity search. We start walking all the comparably sized properties that are for sale inside that target area. Tremendous amount of research goes into this. When we find an opportunity, we make the first offer, and it's entirely based on the seller's financials, which is known as pro forma and is usually, pardon my language, bullshit. So we go in and we do the post-offer work. And we have 3 phases of due diligence. This is where the pro forma usually comes up short. Due diligence number 1. Roof, sewers, repairs. What are the conditions of the units? What do the carpets look like? What about hallways and exteriors? Is the electrical up to code? Is plumbing goods? Do they have collapsed sewers? What about the mechanical, the air conditioning units, the heating units, the boilers? Then we go and look at their financials. Are rents really coming in and match their pro forma? What about occupancy levels? Is everybody paying, or are they delinquent? Is the staff competent and friendly? Do the tenants like the staff? Then we walk all of the other properties that are on sale. to make sure that our pricing is best, our assumptions are sound, and the property that we're buying is really a good buy. It's better than the other 3, 5, 10 properties that are for sale. So this takes a tremendous amount of time. For our property in Chicago right now, we have walked through over 220 of the 237 units because we want to make sure that we know what shape they're in. These days, we also use an iPad-based software to actually map every unit so we know exactly the amount of repairs that are needed and the amount of repair credit that we have to get from the seller. So that's what the next bullet is about. We negotiate the repair credit. Sometimes we reduce, get the price reduced. Sometimes the seller doesn't agree. Well, then we restart at phase one. We drop that property and move back to phase one. Then we talk with about the opportunity with investors. We send you documents, we send you high-def videos of the properties, we do webinars, and then in those webinars, we go through the details financials. Usually those sessions last as much as 2 hours, where investors quiz us very much in detail on our assumptions on profitability, on occupancy, on risk. So we go through that, and there's a number of those events, typically 2 or 3 events for each property that we're buying. Lawyers create legal entities. One of the nice things about multifam is that we typically pay somewhere between $30,000 and $50,000 to lawyers for legal protection. So you're very well protected as investors. As an asset manager, I'm actually less protected. So think of me as standing in front of you. Think of my team as standing in front of you from an asset protection perspective. So it's possible that I could get hit. Not likely. We protect ourselves in a separate LLC, but you're actually standing a step behind us. So you have a very high level of protection. And then the management team works on loans with lenders, investors wire in the money, and the purchase is then completed. So then we make changes to property management teams. In most properties that we've purchased, we tend to either do very extensive retraining in the first 30 days, or we just replace the entire property management staff. Then we start making upgrades, amenities, interiors, exteriors. We start going to the tenants and letting them know that there's a new group in town and we're really committed to tenant satisfaction. And we also improve the curb appeal. We transition out, or in some cases we evict the undesirable tenants and we start bringing in better tenants. It's not unusual for occupancy to first dip and then go back up. And the new people that come in are better quality and they typically pay higher rents. And then we start using our repair allowance. In this case, that's $650,000. Return the out-of-service units to rent-ready conditions so profitability goes up, and improve finishes, whether it's kitchen cabinetry, which is great, or concrete, paving the parking lot. All of these things improve the curb appeal of the property, allowing us to charge higher rents. Now, each quarter, investors get quarterly cash flow checks and also get a forward-looking outlook report. So we tell you how is the property looking, and then you also get detailed financials from the team. And the last part is the sale. So we run the complex, typically I'd say 4 to 7 years, 3 to 5 in the last 3 years, but in the long run, 4 to 7 is a better number. So there's inflation, there's rent increases, we're doing proper management of occupancy while the net operating income keeps increasing, and at some point it hits the exit projections. So the exit projections are provided in advance of your investment, and when we hit that exit projection, we put the property on the market. Typically it sells within the next 90 days. At that point, you receive your principal back. If you're investing with an IRA, your self-directed IRA provider receives the principal back along with profits. So that's what the cycle looks like. And Bill, I am at 4:40, and I think that what I'd like to do actually is to do QA. Questions from everyone. Bill, do you want to open it up?
All right. Well, let me do this. Let me quickly go through my material, then we can open it up for both. Because part of it is how can I afford this? I'll make sure we have a good 5 minutes at the end to get your questions, Neil. So let me pick it up to go through. This sounds awesome, but one of the questions always is, well, can I afford it? And I want to go through how using a self-directed IRA is a way to get involved. And first of all, a little bit about preferred trust. We are a custodian that specializes in self-directed IRAs, and they're a little different than what people normally think about at IRAs that are publicly traded. And I'm going to explain that. First, I want to point out is that we are presenting these webinars as a service to our clients and prospective clients. We don't making any recommendations. We don't do any vetting. That we really encourage everybody to do their own due diligence and investigate everything before they get involved in any particular investment. But one of the things I hear a lot is, boy, self-directed IRAs is something brand new. No, when the IRS created the IRAs, they really had a couple of different classes. One is what you think of as the traditional uh, one that is in the stock market, publicly traded securities. But they also at that time identified the need for a self-directed IRA that can hold real assets. But in both cases, a custodian is required to hold those alternative investments, and that's what Preferred Trust provides, is that custodian. But the real difference is a traditional custodian holds that publicly traded stocks, the mutual funds, the stocks, the bonds, etc., where a self-directed IRA holds real property, whether it's single family, we're talking about multifamily, vacant lots, commercial, or just some of the examples. They can put gold, timber, oil and gas, any type of real asset within there. I talked to some people today, and they're saying the Dow performance so far this year is actually negative. It's gone down about 1%, and the Standard & Poor is up 2%. There are a lot of other opportunities out there in real assets, real property that can return a lot more than that negative 1 or 2%. One of the key things about a self-directed IRA is you decide the type of investments you are interested in, and that's or investing in, and that's why we're bringing you some of these webinars. Certainly, the multifamily investment that Neil just presented is interesting. They're talking about the right kind of returns, but you're in charge of your investment portfolio, not some financial advisor who's getting paid on the transactions that you execute. And again, I point out is that right now the return on investments in the market is running between -2 and 4% with an average of 2.3. And actually, so far this year, it's not even getting up to 2.3. It's running more about 2. And that's just not enough for you to retire comfortably. With an average life expectancy of 82, you retire at 65, that's 17 years you have to fund for retirement. And if you put $200 a month, $2,400 a year, and if you did that since you're age 30, that's 35 years, that 2.3 return on investment is 129,000 spread across those 17 years, gives you an additional $630 a month on top of your $1,500 to $2,000 a month Social Security. It's just not a way to retire comfortably, and that's why you have to look at better and better returns, and why investing in a types of investments that'll get you that double-digit return. Here's only 10%. Takes that $632. Takes that $129,000 to 685 across those 17 years. That's $3,358, almost $3,400 more per month that you're adding to your retirement. And again, it makes it a lot easier and a lot more comfortable to be retiring. So that's why you want to be looking for these higher increases and really maybe move some of the funds that you have in a former employer 401k plan, in a current IRA, maybe in one of your pension plans, and it's a government savings plans, or an inherited IRA. SEP IRAs are for employers, but all of these are different places where $24 trillion is parked that's performing in that 2% average. And again, we're trying to get the word out that you don't have to leave your 401k behind and just leave it in mutual funds. Your IRA doesn't have to just kind of plug along you have options, and those options are within self-directed IRAs. And the key is getting it transferred. If you can transfer money out of any of those, or your savings out of any of those accounts into a self-directed IRA tax-free, there's no tax implication for doing a transfer or rollover into a self-directed IRA. You're not touching the money, you're just moving it from one custodian to the other. Once it's moved, you can then invest in the kind of projects we're talking about, with the income from the projects going back into the IRA with you as the owner. So it'll be titled Preferred Trust Company FBO William Bray for benefit of, as a way to, again, manage the tax flow and to defer any taxes on the income that you're going to receive quarterly on projects like Neil has just been talking about. And investing is easy. If you open an account with us, we work with you and your current custodian to transfer the money into your self-directed IRA, and that is the longest part of the process. That can take 2 to 3 to even, in some cases, even 4 weeks to get the money transferred, because as you can imagine, your current custodian is not eager to move the money out of their account into yours. They're making money on it. So once it gets over to us, though, you can choose your investment and you can execute the investment. You can then projects like Neil just presented, where the income is received back into your self-directed IRA. So key is, if you're thinking about making investments like this or in general, and you're tired of minus 1% up to 2% returns on your IRA, step one is so important, because if you can find a great investment, if you haven't moved the money over yet, you're not prepared to actually execute the investment. Once you have your self-directed IRA open and funded, you're like a cash investor. You're ready to go. And you have a number of purchasing options. You can buy directly with IRAs. You can buy real estate with a lender. It's called a hard money, non-recourse lender. You can loan funds to qualified people. You can do joint ventures. You can co-buy with your IRA and yourself. The only thing you cannot do, and I know Neil mentioned LLCs, you cannot invest in S corps. Yes, you can invest in LLCs. You can actually have your IRA own an LLC in order to do these investments. But there are certain people that are considered to be disqualified, and those are the people you can't loan money to. They can't take advantage of your investments, and that's really up and down the family tree, from your parents on down to your children, your spouse. But what's interesting is you could loan money, you can work and rent out and utilize your brothers, sisters, brother-in-law, nephews, etc. They're considered qualified um, uh, people. Of course, your neighbors and syndications like Neil's talking about are also qualified. You just can't. The key is they're worried about self-dealing. So you can't borrow money from your IRA. You can't sell, exchange, or lease your IRA. You can't take unreasonable compensation out of your IRA. You can't use it as a security for loan because it is protected. You can't transfer the plan to a disqualified person or any of the assets within it. So there are things you can't do, but there's a lot more that you can do with a self-directed IRA, in that it allows you and gives you true self-direction of your investments. It allows you diversification of investments. Again, you can participate in a project or syndication, as Neil has just talked about, with part of it, and you can put another part of it in gold. You can truly make sure you're comfortable with the diversification, that your retirement planning is safe. And all along, the income is tax deferred. Why is that important? What it means is, if you had income of the year of $100,000 and you were taxed at 30% of that, that means that only $70,000 is invested next year into your next investment. If that $100,000 was earned in your IRA, now the tax is deferred. Next year, you're compounding on top of the 100,000, not 70,000. So it just builds a lot faster. You get 10% of 70,000. Now you have $7,000 in addition, 77,000 the next year, and you have 110,000 going into the next year compounded. So it just allows you to grow faster, to have more money at the time of retirement. Yeah, and again, this is an example of a 10% return, and you can think of now instead of months being these quarters that are coming in every quarter on your return on your investment in the syndication. What it's showing here is you make the initial purchase or investment into the syndication, and as the quarterly checks come in, you're going to have opportunities with that additional income into your IRA to keep investing into other things, maybe buying another share of the syndication, maybe it's buying a trust deed, maybe it's a promissory note, to the point where you're ready to make your second purchase. The key is you have the ability to diversify and invest in a number of things, not having that cash just sit there, but you're looking for other investments, whether it's gold, promissory notes, another share in the syndication, until you're ready to make the next major purchase with your IRA to, again, increase the growth. So it's easy to set up your account with us. You can do it all online. All you need to do is fill out the application and send us your photo ID. We're going to do the rest. And it takes, here I said 2 weeks. Again, we have some of the custodians that are dragging their feet. They're taking 3 or 4. But the day we get a signed transfer request from you is the day we start the transfer. And of course, what we're trying to do is get it to happen sooner than later so that you're ready to make those investments, start getting the 10%. We are fully online, where you can actually, we have e-signature capability, where once you're set up, you can authorize investments, you can contribute, all right on online on your screen, and you just go pick what you want, execute it, and then you do your e-signature, and we execute it for you. And when you transfer your current retirement account to us, you select your investments, you determine the strategy, and you choose your retirement, a point of retirement. And again, it's all about building wealth quickly, and looking for those double-digit returns. Do not be satisfied with a -1. And what's interesting, in some cases, that -1, you're paying a 2 to 3% commission to your financial advisor to get the -1. So it is really something to truly analyze. Somebody told me the other day, well, if I go to XYZ company, they're saying my IRA is free. And the point is, nothing's free. They're probably charging 2-3% service on every one of your transaction as part of the transaction cost, where our fee structure, you're going to be paying less than 1%, usually around 0.5% per year as a flat fee on your investment. So it's really worthwhile. We pride ourselves in superior service as compared to our competition. Timely funding. We have a team that executes your transactions. You have the ability to online submit your signature and execute. Again, as a simplified annual fee structure. And we have the highest level of signature guarantee. This is above notary, called a medallion signature authority, where in many cases for large transactions, they're going to be asking for medallion certification, and we have that for you. We have an entire team here at Preferred Trust, from customer service. We manage your transfers, we help with the investments, and we track the income back into your account every quarter to make sure that you know where your status is. And again, you have 7/24 access into your account in order to see exactly where you are and make a determination of what your next investment is going to be. And I'll put Neil's slide back up there in just a second so you know how to contact him. This is my contact information, the phone number there, my email, and our website at preferredtrustcompany.com. We want to be your one-call resource. If you're interested in an investment and you want to know exactly which investment, if it's eligible, if it's part of what can be done in your self-directed IRA, we're here for you. And let me, Neil, put your contact information back up here, giving you back control. And say while you're doing that, what we'll do is open the floor for questions. Again, you can either type your questions or you can raise your hand. And I think, Neil, are you going to do the polling?
No, from a time perspective, that doesn't work.
Yeah,
So I'm not going to do polling.
it's so much good information. I really enjoyed your presentation. I think there's a lot of potential there. And let's see if we have any questions coming in here from our attendees. There's quite a few attendees here. Um, yeah, one of the questions is how do you qualify to invest in your syndication? Do you have to be a qualified investor? What is the minimum investment?
Sure. So depends on the investment. So, we've got one coming up that is only for accredited investors, but usually we tend to have three a year that are for qualified investors. And a qualified investor essentially is somebody that is prepared to invest, and 50,000 is usually the minimum number. Sometimes we can work around that. For some projects we cannot. So a $50,000 investment, and they have to educate themselves. The SEC uses the concept of sophisticated investor. That's what you just did. In the last 45 minutes, I've told you about, multifamily projects. You know that they're illiquid. What that essentially means is that for 4 to 7 years, you don't have access to that money because it's a project, and when it reaches completion and hits its exit numbers, that's when it's going to be sold. Now, having said that, you could sell your share to other people within the syndication, and that does happen fairly often, but still, it's best to have the worst case assumption that it's a fairly illiquid illiquid investment. So you've learned those pieces, and so in a way you've qualified, you've become a sophisticated investor. That plus the $50,000. Some projects do require you to be an accredited investor.
Okay. I think, and again, the question here is I'm gonna help answer it here. What do we mean by passive? And I think in comparison to if you're going to be flipping houses, you hear about great potential, great income, and it happens, 9 to 12 months, but it's a lot of work. And if you have if you don't use a syndication, if you have income property that you have to manage and you have to worry about the occupancy, it's a lot of work. Versus having a syndication that you're describing here, where they do the work and you get the results of their efforts, is what is meant by passive. And yes, that is something that is qualified to be part of your self-directed IRA, is investments in the syndication that has been described here.
And I want to emphasize just how passive this is. If you're the kind of guy that likes physical checks, the work that you do is you walk to your mailbox and grab the check that we send you. If you're, an online sort of guy, yeah, you don't even have to do that because the money goes into your bank account. There really are no duties that investors have. And yes, I like flipping. I've done flipping myself. It is profitable. So, and having done something like that myself, I wouldn't say that it's a bad thing to do, but it is more work than you would think when you're going into flipping. Rehabbing involves a large number of decisions that truly only an investor can make. If the rehabber is making those decisions for you, that's not good for you.
Yeah, I think that I talk to people all the time that flipping was very attractive, and then they get into it and realize how much work it really is, and that's why I was emphasizing there. The nice thing about a self-directed IRA is you get to choose how much you want to do, and I just keep emphasizing you want to really be looking at the return and think about growth within your IRA. Do not be complacent. Do not be passive and say 2% is enough. I tried to show you it is not, and you need to think about these other opportunities for investment. Unfortunately, I think we only were able to take a few questions here. Everyone, Neil's contact information is on the screen, 510-972-3641. His email is info@financial-attunement.com, ATTUNEMENT. You can email him with questions. You also saw my email up there, bbray@ptcemail.com. email either one of us. We coordinate well. If there's any questions, any more information you'd like us to get out to you, please let us know. And on that note, Neil, I'm going to thank you for your input. I think it was very valuable, and I look forward to our people working with you going forward.
Well, thank you very much, Bill. This was fantastic. And if you folks are interested in multifamily investment, please do reach out to me. We've got a fantastic opportunity that we are working on right now that we'd love to tell you more about through a video and through a document that has all the information. So please do reach out to us. Thank you again, Bill. This was fantastic.
All right.
Thank
Have
you.
a great day, everyone, and thank you.